Hi folks, Chuck Gibson from Financial Perspectives. After last week's drubbing of the precious metal sector, I want to do a quick video to give you my thoughts on what may lay ahead, and also an interesting setup that I'm watching. I'm going to use the miners ETF GDX as my proxy to analyze recent action in precious metals. It matters not whether you use gold or silver or the miners, since all the charts look the same. In the daily chart of GDX, you can see price broke out of its consolidation range in January here, after this false breakdown, which turned out to be a textbook bear trap. From that point forward, it represented the strongest sector in the market, rising some 150% from its trough in January to its peak some 8 short months later. That's one heck of a climb. In a market this strong, quite often price will form a rising wedge, which can be a warning sign that price has gone too far, too fast, and a correction lay ahead. You can see price begin to falter after making the requisite minimum 5 touches to the wedge boundaries. In addition, the bearish pattern was formed while momentum was creating negative divergence, which added more credence to a potential upcoming correction. As price broke down out of the wedge after a 20% decline, it found support here, which eventually failed on the third retest. On Tuesday the 4th, GDX gapped down and lost 10% as more than 225 million shares were traded. Notice how price filled that open gap here and is approaching the first level of support here, which I've labeled as S1. Also notice that this is very close to the red 200-day moving average, and while not marked, is also the 50% Fibonacci retracement, and also very close to the pattern's downside target. In strong thrusts, price has a tendency to overshoot its targets, but with the confluence of signals in this area, I still expect price to settle down at S1, as it did on the counter-trend correction over here on its way up. With all the warning signs, one may ask why I held on to our positions. Well, at support here, our general process rules state we're to sell on the day price closes below that level, which meant we should have sold on Tuesday. But as you know, Tuesday turned out to be the day the entire sector was taken out to the woodshed and beaten with a stick. But we didn't sell because we have other rules that forbid selling under those explicit conditions. Now, with positive divergence forming on multiple time frames, combined with the confluence of signals, odds are we see a bounce in the coming days or weeks, which should provide a better selling price than what last Tuesday provided. The odds are in our favor this will occur, but the market provides no guarantees. There is always the possibility of further weakness where price could eventually settle at major support 2 here, after closing this gap. To close on a positive note, the longer weekly charts still look very strong and provide nothing to indicate the end of the bull is upon us. This, combined with upcoming seasonality tailwind, I do expect we see higher prices ahead. There is significant overhead supply above that must be absorbed though before prices can move much higher. I want to go back to the GDX chart real quick and revisit the setup that developed before the correction occurred before I move on to my last chart. Note the rising wedge, negative momentum divergence, and open gaps below, and price weakening after 5 alternating touches on the wedge boundaries. A breakdown below the pattern boundary here, followed by a quick 28% correction. With that in mind, let's take a look at my next chart, which is that of VTI, the ETF for the U.S. Total Stock Market Index. It's the broadest index comprising some 4,500 U.S. companies. Let's review its current setup. Other than the steepness of the wedge, this is almost exactly what GDX looked like before its almost 30% flush. A rising wedge, negative momentum divergence, open gaps below while price struggles to stay within the pattern's rising supports. Technical analysis teaches us that patterns repeat across all time frames and investments. This is because price movement is a reflection of the people that trade the investment, not the investment themselves. And the people don't change. The good news is that if you're overly worried upon seeing this pattern, is they all don't turn out like GDX. Rising wedges, especially for downward breakouts, are some of the worst performing chart patterns. Downward breakouts have unacceptably high failure rates and small post-breakout declines. Also, pullbacks occur in almost 2/3 of the time, and throwbacks happen almost 3/4 of the time. I want to close by saying, while this pattern is in development as of right now, nothing's broken. With price above a rising 200-day moving average, it could just as easily continue its consolidation and break out to the upside, not down. which would invalidate the pattern and the setup. Either way it turns out, it's something worth watching if you're long U.S. stocks. Well, that's it, and thanks for listening.